Hi, I'm Thibaut. I work in climate finance, helping nature-based projects get money. A few weeks ago, I traveled across Southeast Asia to see how it all works on the ground, meeting project developers, communities, and interviewing around 10 people on different climate finance mechanisms to fund their projects. So here is the 7th episode, How to Fund Nature at Scale. In this episode, we're going to cover the last challenge, secure large-scale financing. Firstly, by introducing several sustainable finance instruments. So, to scale impact, you need bigger leverages, like day financial swaps or payment for ecosystem services. So they move millions and billions, and these investments often have a greater impact that goes far beyond simply protecting nature. I actually remember what head of village told me after an audit. When I asked him what his biggest priority would be if they had more funding, he didn't mention trees or carbon at all. He just said, we need roads. And even if there are roads, some can be really hard to ride. And we can see it here when we were heading to an agroforestry project in central Kalimantan. That's also what most project developers look at before knowing if they want to start a project while doing their land qualification areas. The head of village told me this. If we had better road access, people could sell their products. And with that, we could finally connect to the government's electricity program. But right now we can't. We're too remote. We need at least 13 kilometers of roads. And when I asked what would happen if the project ended, he said quietly, maybe the community will be jobless. We live far from the city, and most people never went to school, so finding work would be impossible. They would likely return to building their homes within the projected forest, just like they did before the conservation project began. But so, how do those sustainable finance mechanisms work? How do they differ compared to traditional loans or conventional debt that you see in the traditional finance sector? Let's start the topic by asking one of our project developers, how would you describe sustainable finance?
Sustainable finance is not a form of debt, it is not a form of loans. Rather, it is a blended finance vehicle comprised of various instruments that can be treated as a grant, yet on a commercial basis. And all of the underlying projects or the underlying risk is not so much on the ability to pay, but it is on the success of the project and the underlying natural assets.
As we can see on this slide that I adapted, one example could be the Rhino bond by the World Bank. The outcome there were based on the amount of rhinoceros that will come back. And what's really compelling about this tool is how they integrate seamlessly with existing financing mechanisms such as carbon credits, CSR funding, or philanthropy. A good example of the mix of those funding mechanisms is this one. A recent Carbon Capital Lab study from September 2025, based on 74 nature-based project developers, showed that among the 25 developers using carbon offtake agreements, 85% also relied on debt financing. But keep in mind, of course, this sample is not representative of all projects globally. And let's ask one of our project developers, for instance. So Don is doing carbon credits, but which sustainable finance instruments is he considering for his project in Sri Lanka?
Other forms of financing, once we have an investor on board, we could even potentially look at raising grant capital, because again, there's a strong social element to everything that we do. It is not only reducing greenhouse gas emissions. So once we have investment on board through a prepayment model, it is possible to raise debt at very concessional rates. It is possible to raise grant financing. It is possible to have an equity investment stake. So again, it is a blended finance instrument. It's a blended finance vehicle, and we can consider all of these instruments rather than looking at it in silos.
So yes, as Don said, you have different blended finance tools, funds, and a lot of different actors that are involved in this market, as you can see here on this scheme. So it's a really good scheme that I could find to summarize the different tools of blended finance. And don't hesitate to pause, of course, if you are interested. What I wanted to show here is the size of the investments. So it goes from under $20 million per investment for some debt or equity funds, and it goes to 200 million till $1 billion for capital stack with junior, senior tranches, and sometimes mezzanine debt. It's a bit technical, so we're not going to focus too much on it, but we understand that those tools now enable countries to monetize their natural assets as investment opportunities, unlocking returns for capital markets. So this is precisely the value proposition of debt for nature swaps that we will focus on now. There are, of course, other type of mechanism, but unfortunately, I didn't have the time to focus on them. So, to define it simply, a debt for nature swap is a financial mechanism where a portion of a country's foreign debt is restructured in exchange for commitment to conservation or to fund sustainable development projects. This approach allows countries to reduce debt burdens while directing resources toward protecting ecosystems, biodiversity, and climate resilience. As you can see here, this kind of mechanism often takes the shape of a long-term conservation trust fund, basically a structure designed to channel the money to local stakeholders and protect the designated areas. But to make it easier to understand, here's a real example. A date for nature swap signed in January 2025 in Indonesia to protect its coral reefs. In this deal, the US government, so USG here, forgave $30.5 million of Indonesia's debt. And in exchange, Indonesia committed $35 million from its national budget into a conservation trust fund to protect coral reefs. NGOs added an extra $4.5 million, not to increase the fund, but to cover technical work, monitoring, and governance. So together, this package mobilizes nearly $40 million for nature, but through separate financial streams, and USAID helps structures the entire transactions. This is a pretty good example of the use of this mechanism, and I'll quote a legal advisor with Conservation International who worked on the last Indonesian deal for that, explaining that debt for nature swaps were specifically designed to break the cycle of debt strains contributing to environmental degradation. They are not magical, of course. They can also cause risks if terms are unfavorable or externally controlled, but debt for nature swaps can also preserve sovereignty if they are structured pretty equitably. And let's focus on one country now, Sri Lanka. Did they assign a monetary value to its natural capital assets?
Sri Lanka has not yet put a monetary value on its natural assets. And should we do that, should we embark on that goal, we will be able to leverage, securitize our natural assets without selling our land, without selling any physical space here.
Above all, this tool encourages countries to reflect on their natural assets and on their financial standing, even though debt restructure shouldn't be the sole focus of such swaps. There are already cases that happened in the past, as we could see in Indonesia, but there are also way more. And to understand why, I asked an economist focusing on sustainable finance if he had any thoughts on how the for nature swaps can be a tool for countries to value their natural capital.
Seychelles, Belize, Barbados, Ecuador, Gabon, El Salvador, so on. And in all of these cases, what was clear was that they was recognizing that they need to value natural capital. This, even though we call these debt for nature swaps, structuring wasn't the only criteria. It wasn't necessarily the primary motivation. It also was to unlock new sources of financing for conservation, for missions, for adaptation, and so on. So interesting because it means that this instrument is being used not just to resolve debt challenges, to help countries that might be in debt distress and one element in that the process, but rather it is being used to free up resources for nature.
And it means the country has to take stock of its natural capital, because these mechanisms only work if there is a proper audit of the land and its real conservation value. Anushka explains the conditions needed for that.
But some very specific mechanisms that are needed in a debt for nature swap or a blue bond, green bond, bond context are still lacking. For example, Sri Lanka would need to set up a conservation trust fund that is in a special purpose vehicle kind of model under new rules, new flexibility that permits foreign players to participate, that permits international actors to play a role in governance and scrutiny. Sri Lanka will also have to have some baseline measures and baseline indicators for the nature outcomes it needs to commit to, and then also be okay with a regular follow-up to see whether those nature outcomes are being met, because that's what we have asked for with a debt for nature swap.
So for it to take place, you need strong collaboration between all the key actors, from local stakeholders to the official in charge of environment, climate, and biodiversity.
If these two groups don't work together, then we don't benefits of these kinds of nature-linked sovereign debt instruments, and there's going to be a lot of confusion, a lot of disagreement, a lot of poor outcomes.
However, those type of financing are more at a macro level and decided within institutions themselves. So a project dev could push by doing lobbying and being aware of what's happening, but it can't really lead the transaction itself. So then, what is the role that project developers play in these transactions?
Yeah, I think the project developers play an important role, but they play a secondary role compared to the government authorities in the country that have to really recognize that this is an instrument that they want to take on. Because remember, these are sovereign instruments whose implications of which matter for all citizens, so it can't be seen as a commercial transaction only.
So these mechanisms are not just technical, they are political, and they need a big consortium to be developed in a transparent way.
I think the project developer deserves a transparent and credible mechanism supplied by the government in order for them to actually come in and play in this space. They need clarity on what the government will do. They need clarity on who they have to deal with. They need clarity on what kind of nature outcomes the government is committing to. For example, 30 by 30 targets or anything similar like that. They need to know what the terms are. And the lack of clarity on that would turn developers away.
But before reaching this level of clarity, it's still worth checking those different sustainable finance tools, including debt for nature swaps, to then get a glance of what could happen possibly in the future. For that, I'll introduce the Belize Blue Bond from 2021 in Latin America, located here. We are not going to dive too much into it, but here is a short presentation of this blue bond and swap. So, before the deal, Belize was carrying a so-called super bond of about 553 million US dollars, which had become unsustainable after years of economic stress, and the impact of COVID-19 made it worse. What happened then? Well, with support of the Nature Conservancy, Belize bought back that debt at a deep discount and replaced it with a new instrument, a blue bond of about $364 million. Credit Suisse, now called UBS, arranged the transaction, and TNC provided guarantees and technical support. So, the amount was way higher than the Indonesian bond, since it had a value of 35 million USD, but it was also for a different context. If you're a buyer, we can take the example of the investors that were involved in the Belize Blue Bond fund in 2021, where they all decided to swap for another bond to reduce their investment risk. And the deal was a win for all sides. So investor got cash, Belize reduced its debt, and while integrating conservation funding into the structure. So then, following this example, which debt for nature swaps could be recommended to look at?
Across all of these examples, there are different reasons why they're interesting. And it could be on the structure and composition of the conservation trust fund. It could be on the financial transaction, the fees, the credit enhancement, the credit guarantee. And there would be also a bucket to compare on how they did the climate and conservation target development and the commitments around that. So I would encourage anyone to look at least these three areas when trying to find the most relevant example.
So, date for nature swaps can't be applied for every cases and aren't a magic fix. But what is good with them is that you can take nature as part of your national financial plan. And it's really a shift in the mindset of from seeing conservation as a cost to seeing it as an asset. Still, these instruments stay mostly at the macro level, led by governments, banks, and international institutions. The project developers I met are usually eager for this type of innovations. That's actually why they were open to inviting me in the first place, for instance. And because if we can offer them new ways to finance their work, we absolutely should. And most of the project developers I met had an opinion about some problems or issues that should be solved at a macro level. So, in this episode, we explored how date for nature swaps work, what they can unlock, and why they depend so heavily on transparency, national readiness, and strong collaboration between institutions, project developers, and governments. So, these mechanisms are not perfect, and they are not a solution for every country, but they show how nature can finally be treated as an asset in financial planning, not just as a cost or as a conservation burden. In the next episode, we will take a few steps back on the different lessons and key lessons that I learned from this whole journey. And then we will look at what matters when you are starting your own project or when you want to finance nature. The project developers are the ones that are feeling it the most at a macro and at a micro level. So here are 7 lessons about the barriers faced by project developer when they want to implement their projects. It can have an effect on whether financing continues or not. So here are 3 thoughts and advice on creating projects that stay viable, resilient, and trusted across any funding model.